Ryan. It's been quite a while since I've done a daily update for you guys. Today is December 31st. It's Friday though, and I thought it'd be a good opportunity to come back in and just talk through how we finished up for the year utilizing the BTX method. And what is the BTX method? It's the thing I've talked about every day for the last, I don't know, year and a half, 2 years now. It's a super simple way to approach the market using tools that already exist in your trading platform uh, that allow you to take a systematic, quantifiable approach to the marketplace without spending a ton of time just sitting there staring at candles paint and repaint, right? And will give you a positive expectancy over the long term in the marketplace, right? I'm going to run through real quickly just what we're looking for when we utilize the method, how we use it, just to give a recap of that. And then I'll show you the results that we got over the course of this year, which, it's an expected outcome. Uh, it is what it is. A lot of people go, oh, you can't do something that simple and still make money in the markets. And my argument has been for years now, you absolutely can. You can make, really, quite honestly, you can make pretty amazing returns flipping a coin, as long as you give yourself a positive expectancy. You can flip a coin and choose to go long or short based on heads or tails, as long as you're giving yourself the opportunity to win a greater amount than you lose. So if you're, risking 1%, you always have your take profit at 2%, let's say. This doesn't use a fixed, but you can. The BTX method doesn't use a fixed profit target. You can use it, well, it does have a profit target, but it also uses a trailing stop. There's a couple of nuances to it, but ultimately, we win more than we lose, which gives us positive expectancy over the long term. And using a very, very, very simple way of approaching the market, working in the market trend. So looking at a way to quantifiably measure the market trend, looking at a measured way to decide your entry based on that market trend, and then a measured way to look at your maximum risk each time, take off risk as the market moves in your favor, and you have a profit target as well. All those things combined give you a very simple trading method with a positive expectancy that works quite well. What is the method? We've talked about this ad hoc, but I'll do it again. The method is we look for the market trend. So I'm just using crude. We're going to go back a few days because there were a couple days in a row that we had big moves on crude, or this actually, was worked out really well for us. There's a lot of days where obviously it doesn't work, and that's okay. That's part of the method. But what we're looking for is we want to identify the market trend. So we have you'll see 4 lines on the chart. These 2 lines here at the top, the orange line and the blue line, are a 4-hour trend. So I'm looking at my, just simply looking at an exponential moving average on a 4-hour, and I'm looking at it on a 30-minute, and I'm trying to see what's going on with the marketplace. I've got a fast-moving one and a slow-moving one on each of these. It's a 100 and a 20. So a 100 EMA and a 20 EMA for the 4-hour, and then a 100 EMA and a 20 EMA on the 30-minute. And I'm using a 30-minute chart to time my entries. So we're looking at these to determine market bias. If the fast-moving line, EMA line, is below the slow-moving EMA line, that's telling us that we're looking for short opportunities. If it's flipped, and let's say the green's above the red, if the blue is above the orange or the green's above the red, that means we're in a long bias, right? So ultimately, we're just coming in and we're looking to see what's our market bias. What's it say on the 4-hour? What's it say on the 30-minute? If they're in agreement, then we're looking for that direction. So like right now, looking at crude, we've got a short bias on the 4-hour. We have a short bias in the 30-minute. So short, that tells us that we'd be looking for short trading opportunities. Then we simply wait for the market. We wait for the market to push up in this case, right? We want to see it make higher lows and higher highs, higher lows and higher highs. And as it's doing that, we give ourselves a little opportunity. We say, hey, we've got something going on here. Maybe we have a tradable opportunity. So as it's making those higher lows and higher highs, we're waiting for that candle to close. And then on the next candle, we want to see if it's got some momentum that might push it down below that previously closed higher low, right? If it does, boom, we enter the trade. And then we're looking at a 2-to-1 profit target, or sometimes a 3-to-1, depending on what instrument you're trading. You might have a little wider breadth depending on how volatile that instrument is and how much opportunity there typically is for movement. But that's a discussion for a whole other time. But in this case, we'd see it break down and then it pushed on down into profit right there. You see the same thing again a little bit further on, a couple days later, short bias, 4 hours short, 30 minutes short. You want to see the market pull back. So it's making higher lows and higher highs, higher lows and higher highs. And then boom, it breaks down, gives some momentum through the bottom of that previously closed candle. And then you can see that you're in, and then we start trailing off the, trailing off the risk as the market moves in our favor. Bottom of each, the top of each closed candle, we're just ratcheting our stop loss down, and ultimately, this one pulled back and then took us out here. But that's all we're looking for. It's that method applied the same way. If you're going long, let's see if we've got some long opportunities somewhere. If you're looking for long, here's gold the other day. We're looking for long. So in a long bias, you can see the blues over the orange. You've got the 4-hour bias is showing long, the 30-minute bias is showing long. New market session begins. We want to see the market start pulling back. It's going to make lower highs and lower lows, lower highs and lower lows. And then at the top of that previously closed candle, right, the market breaks out of there, and then we can see it has the opportunity to move on and get us into a little bit of profit. You're just ratcheting off risk as the market moves. You're not getting too excited, not getting too antsy, you're not trying to force anything. You're letting the market do what the market does. And then, ultimately it's either going to move on to your profit target, or it's going to, slowly ratchet off risk and then come back and take you out. But that's all there is to it, guys. It's a super simple trading method. But the reason it works is because you're able to win a larger amount on average than you lose. Your average losses are smaller than your average wins. That gives you an edge over the long term. It doesn't mean you win every trade. It doesn't mean my cat just opened the door. It doesn't mean that you win every trade. It doesn't mean that you win every single day, every single week, every single month. You've got losses. That's part of it. But the thing is, when you're able to win a greater amount than you lose, you can have a much lower win percentage and still be profitable. As a matter of fact, with the right profit ratio, you could win only 30% of the time, and you can still be profitable. So a lot of folks, look at trading methods, they look at trading systems, they think they've got to win all the time. I need a system that wins 85% of the time. You might, if your wins are much smaller than your losses, then yeah, you have to win a whole bunch. But if you have the right math and you give yourself a real edge and that positive expectancy over the long term, you don't. You can have a low win percentage and still be profitable. As a matter of fact, here we are for the month. I'll just pull this one over here. Let's see, here we are for the month. We're looking at December. We had 4 trades on the S&P. A lot of these didn't pan out because the risk was too high. Remember, for our model portfolio over here, we're keeping a certain level of risk so that we don't exceed a large percentage of our overall portfolio. If we did have a series of losses, we don't want to draw down too much. We don't want to take ourselves out of the market because we're having excessive risk. So we capped our risk at $500 per trade on a hypothetical $10,000 account. So we're going to have some of these trades that we simply don't take because, like on this one over here on gold, this was about $700 of risk from the top of this candle to the bottom here. So when you're looking at the close of that previous candle, even though it had been pulling back and was a nice pullback here, at the top of this candle where you would enter, your maximum risk to the bottom of this was significant. So you had to pass on that trade. Anyway, I digress. We're not going to go, we've talked about all those trading rules a number of times, but ultimately, you can see where we had, quite a few trades. We ended up losing on the S&P as itself. Crude, we had 4 trades in crude that we could actually take. crude was rocking and rolling. That was the big winner over the course of December. And then gold, gold we had loss, and then a win here at the end. But ultimately we still, mainly because of crude in this time, ended with about 11% on that hypothetical account. So if we're looking at performance for the entire year, we can see that tracking every one of our trades here, utilizing this method based on the rules that we set up back in late December of last year, the rules that we set forth for all of these trades on that basket. Remember, we're always trading a basket. We're trading the S&P, gold, and crude. Why a basket? Because sometimes, when one's moving, the others aren't. So we spread our risk across 3 different instruments that aren't absolutely correlated. And that way we have the opportunity to take advantage. So when one market's flat, another market might be moving. It gives us greater opportunity to recognize these potential gains, right? But ultimately, here we are, finishing the year with no compounding at all, utilizing fixed lot sizes that we identified at the beginning of the year. So again, there's no compounding, there's no ratcheting up or ratcheting down our lot size to make the most of each potential trade. That's a big piece. This could have been significantly higher had we, obviously if we compounded month over month, that would have had a significant change in the overall outcome there. B, if we had maximized our trade size, that would have had a significant outcome as well. So many trades that we passed on, we could have taken if we had sized down the lots, right? If we had adjusted the lot size to be right at the maximum risk of that $500, right? And then the same for ratcheting up lot size. There's many times when we had a very, very low risk of just $100 or $200 that ended up being a significant win. It would have been even more significant had we maximized our lot size by adjusting it to the account to have a fixed percentage of risk rather than a just fixed lot size risk. Anyway, neither here nor there. You can do with that what you will, because ultimately it's up to you to figure out what your risk tolerance is and your risk parameters are. But as you can see, finishing up the year here on our model portfolio, tracking every trade over the first couple hours of the trading day, just like we had laid out at the very beginning of the year, or actually it was the end of December last year when we put all the trading rules and the plan in place to track it like this. But you're about 90% on your hypothetical account utilizing this very, very, very simple trading method that we've just gone through. So anyway, I'm going a lot longer than I typically go on these, but I just want to hammer home. You don't have to overcomplicate it. There's a ton of systems out there. There's a ton of people selling you this, that, and the other, and want you to believe that trading has to be significantly complex and significantly difficult, and you have to have a very high win rate, and you have to have some sort of an EA or some sort of a machine that's doing it all for you, and it's going to change the world. Okay, maybe some of them, sure. I'm giving you something here for free. Goodness of my heart, because I've been in this game and I've seen it for so freaking long. Just, guys, don't overcomplicate it. Do the simple stuff that works. Rinse and repeat. Do the simple stuff that works. Do the simple stuff that works. Do the simple stuff that works. I know I sound like a broken record. I've been told I sound like a broken record for the last 10 years. I don't know what to tell you. I've showed you over the course of this year, you can do something crazy simple, crazy easy, 90% return on the model portfolio that we've tracked here, utilizing 3 simple rules. I don't know what else to do. So there you go, guys. Happy New Year. I'll come back next year. There's another simple process that we can use. I think maybe in 2022, we'll show you another one. And I'll just prove again that you can do something simple and it'll freaking work because it's simple. And because it's simple, you have the chance to stick to it. And because you have the chance to stick to it, you'll allow it to actually work and maximize that positive expectancy over the long term. There you go.